Hey there, good to see you. So, you might have seen the headlines. Home prices are dropping in cities all across the country. And if you're like most people, you're probably asking, okay, is this good? Bad? Or just another weird twist in the economy? Because on the surface, falling home prices might seem like a win for buyers. But dig a little deeper, and it starts to look like a warning sign. Something bigger might be brewing beneath the surface. Here's what caught my attention. In over 100 major US metro areas, home prices are now lower than they were a year ago. That's a sharp shift from just 6 months ago. And guess what? The cities that skyrocketed during the pandemic, Austin, Tampa, Miami, are now seeing the biggest declines. So yeah, this isn't just a minor correction. It's starting to feel like a broader trend. Community call out. But before we dive deeper into the why, I'd love to hear from you. What's happening in your local market? Are homes sitting longer? Are prices softening, or is everything holding steady? Drop a comment and let me know. I read every one, and it helps us all see the bigger picture together. And if you're into real talk about money, housing, and the economy, hit that subscribe button. I'd love to have you here. What's causing the drop? Let's break down what's happening, and why this goes beyond just real estate. Housing isn't just about buying and selling homes. It's one of the major pillars of the entire economy. When housing slows down, the ripple effects hit hard. Construction jobs, mortgage lenders, furniture sales, home improvement stores, even your local hardware shop. That's why, when top economists like Moody's call this a red flag, people pay attention. The key culprit right now? Mortgage rates. We're sitting around 7%, way up from the 2 to 3% rates buyers locked in during the pandemic. That change alone makes a massive difference. Here's an example. A $400,000 house at 3% interest felt manageable to a lot of buyers. But at 7%? That same house now feels out of reach. So what happens? Fewer buyers' homes sit longer, sellers start slashing prices, the market cools down, and there's another layer to this. Homeowners feel stuck. People who locked in those ultra-low rates don't want to give them up. Selling now means taking on a new mortgage at double or even triple the rate. It just doesn't make financial sense for most. Inventory is up, kind of. Now here's the twist. Even with those locked-in homeowners, inventory is actually rising. At the start of the year, there were about 830,000 homes listed. By June, that number had jumped to over 1.1 million. But that doesn't mean sellers are confident. In fact, delistings, people pulling their homes off the market, are up 47% year over year. That tells you something. Uncertainty is creeping in. So we're in this weird in-between zone. Sellers don't want to sell, buyers can't afford to buy, and homes are just sitting. Builders are backing off, home builders are feeling the slowdown, too. In June, single-family housing starts dropped nearly 5%, and new home sales fell 13% in May alone. Some builders had been offering incentives, like covering part of the buyer's mortgage rate, but that's getting expensive and harder to sustain. So now, many are delaying projects, holding off on land purchases, slowing down construction overall. It's not hitting everywhere equally. Geography matters here. The South and Mountain West, places like Texas, Florida, and Arizona, are seeing the biggest price drops. These areas boomed during the pandemic thanks to remote work and migration. But they also had the steepest price spikes, which means they had the most room to fall. Meanwhile, Midwest and Northeast markets are holding up better. They didn't see the same wild price surges, and they haven't built as much new housing. But even these regions aren't immune. They're starting to feel the strain from high rates and economic uncertainty. The bigger picture. So what's the broader story here? The Federal Reserve has kept interest rates high to fight inflation. That makes borrowing more expensive, not just for homes, but also for cars, businesses, credit cards, everything. The goal is a soft landing, slowing down the economy without crashing it. But housing reacts fast, and when housing stumbles, other parts of the economy tend to follow. We're already seeing Layoffs in real estate and adjacent sectors, unsold home inventory at the highest level in 15 years. Yes, going back to the 2008 housing crisis. Now, I'm not saying we're heading for a repeat of 2008. The financial system is more stable now, and we don't have those risky subprime loans floating around. But it does mean housing is under pressure, and the whole economy is watching. What to watch going forward? So what should you keep an eye on? Interest rates. If inflation keeps easing, we could see rate cuts later this year or early next. That would take some pressure off the market. Wage growth and job security. If people feel stable in their income, they're more likely to buy, even with higher rates. Consumer sentiment. If confidence drops too much, it could tip us further into a slowdown. Final thoughts. Look, falling home prices might seem like a silver lining for buyers, but they can also signal deeper shifts in the economy. What I'll be watching closely is whether this slowdown stays regional, or starts spreading nationwide. That will tell us a lot about where we're headed next. Now I want to hear from you. Are you thinking about buying or selling a home right now? Or are you sitting this one out? Leave a comment and let me know what the housing market looks like in your area. And if you found this breakdown helpful, consider subscribing or sharing it with someone who might benefit. Take care of yourself, and I'll see you in the next one.